If you or your spouse spent money installing grab bars, a walk-in shower, a stair lift, or a ramp in your home, the CRA owes you up to $3,000 back on your taxes. And right now, thousands of seniors across this country are leaving that money sitting on the table because nobody ever told them it existed. That's not a rebate program you have to apply for months in advance. That's not a grant with a waiting list. This is a line on your own tax return that most seniors, and honestly a lot of accountants, just skip right over. I'm John AJ. On this channel, we break down real CRA and Service Canada rules to get you every single dollar you deserve. If you haven't subscribed yet, hit that subscribe button right now so you never miss an official payment update. Today, I'm walking you through CRA line 31285 DARS and how to use up to $20,000 in home accessibility upgrades for a maximum $3,000 refund check. I'm going to show you exactly what qualifies, what doesn't, who's eligible, and the exact steps to put this money in your pocket this tax season. Stick with me to the end because I'm also going to show you a trick for claiming this credit twice on the same expense, completely legally. Part 1. What exactly is the Home Accessibility Tax Credit? Let's start simple. This credit is officially called the Home Accessibility Tax Credit, or HATC for short. On your tax return, you'll find it as line 31285. It used to be called the Home Accessibility Expenses line, and some older CRA guides still referred to it that way, but it's the same credit. What is it? In plain English, the HATC is a federal non-refundable tax credit built specifically to help Canadian seniors and people who qualify for the disability tax credit pay for renovations that make their home safer and easier to live in. The whole point of this credit, according to CRA's own policy language, is to support what's called aging in place, meaning seniors staying safely in their own homes instead of being forced into a care facility before they're ready. Now, I know some of you watching this are already thinking, John, is this actually CRA approved, or is this one of those things that sounds too good to be true? I get that question in the comments every single week. And the answer is yes, this is 100% a legitimate line on the Canada Revenue Agency's own T1 general tax return. It's not a loophole, it's not a gray area. The government put this credit in the tax code on purpose, specifically for people like you. What is it worth? Here's the number that matters. You can claim up to $20,000 in eligible renovation expenses in a single year. The credit rate is 15%. So if you do the math, $20,000 times 15%, that comes out to a maximum tax credit of $3,000. Now, that $3,000 isn't a check that shows up in your mailbox separate from everything else. It's a non-refundable tax credit, which means it reduces the amount of federal tax you owe. If you owe $3,000 or more in federal tax for the year, this credit wipes that owing down to zero. Money that stays in your pocket instead of going to the CRA. And here's something a lot of seniors don't realize. You don't need to spend the full $20,000 to benefit. Say you spend $8,000 putting in a walk-in shower and grab bars. $8,000 times 15% is $1,200 back. Say you spend $12,000 on a stair lift, that's $1,800 back. Every dollar you spend on a qualifying renovation up to that $20,000 ceiling is working for you at 15 cents on the dollar. Part 2, what actually qualifies and what doesn't. This is where most people get tripped up, so I want to be very precise here. What qualifies: walk-in bathtubs and walk-in showers, grab bars and the reinforced backing needed to install them, wheelchair ramps, both permanent and portable, stair lifts and lifts, widening doorways and hallways for wheelchair or walker access, non-slip flooring installed specifically for safety, lowered countertops and cabinets that improve access. The common thread with every one of these is that CRA looks for two things. First, the renovation has to be permanent, something that's built into the structure of the home, not a piece of furniture or a portable gadget you could take with you if you moved. Second, it has to either help you get into or move around your home safely, or it has to reduce your risk of harm. Think falls, burns, or getting trapped somewhere in an emergency. What does not qualify: routine home maintenance like painting or general repairs, roof repairs and replacement unless directly tied to an accessibility renovation, routine plumbing or electrical work that isn't accessibility related, heating and cooling system replacements done for comfort or efficiency, not accessibility, purely aesthetic upgrades, new countertops just because you want a different look, new flooring just because the old flooring is outdated. So here's a real world way to think about it. If you're repainting your kitchen because you're tired of the color, that's not eligible. But if you're lowering your kitchen counters and cabinets so you can reach them from a wheelchair, or because standing for long periods causes you pain, that is eligible because it's improving your ability to function safely in that space. Now, a lot of you are probably wondering, what if my renovation is a bit of both? What if I'm redoing my whole bathroom and some of it is pure style and some of it is accessibility? That's a fair question, and it comes up constantly. The answer is that you can split it. You only claim the portion of the cost that's tied directly to the accessibility improvement. Keep your invoices itemized by your contractor so the accessibility-related costs, the grab bars, the walk-in shower unit, the non-slip surface, are clearly separated from the decorative parts like tile color or fixture style. This is exactly why your paperwork matters, and I'm going to cover that in detail in a few minutes. Part 3. Who can actually claim this credit? What is it? The HATC is built around two categories of people: what CRA calls a qualifying individual and an eligible individual. A qualifying individual is either a senior who is 65 years of age or older by the end of the tax year, or someone of any age who qualifies for the disability tax credit, meaning they have an approved Form T-2201 on file with the CRA. What is it worth? This matters because of who is allowed to claim the renovation costs. If you're the qualifying senior and you own the home, you claim it yourself. But here's the part that saves families real money. If the senior in the household doesn't have enough taxable income to use the full credit, or doesn't owe enough tax to benefit from it, the credit can be transferred to what's called an eligible supporting family member. That's typically an adult child or another relative who lives with the senior or supports them, and who has claimed things like the caregiver amount or an amount for an infirm dependent on their own return. So picture this scenario: an 81-year-old widow in Alberta, living on a modest CPP and OAS income, has her adult daughter install a walk-in tub and grab bars in her home. The mother's income is low enough that she doesn't owe much federal tax, so claiming the full $3,000 credit herself wouldn't help her much. She can't use a credit against tax she doesn't owe. But her daughter, who lives with her and provides care, and who claimed the caregiver amount on her own return, can claim the HATC instead and use the full $3,000 against her own tax bill. How do they get it? To transfer the claim, the family member needs to be able to show they qualify as a supporting relative under CRA's definition. Generally, that means they've claimed or could have claimed an amount for an eligible dependent, the caregiver amount, or the amount for an infirm dependent in connection with that senior. If you're not sure whether you qualify as the supporting relative, that's a conversation worth having with a tax preparer, because getting this wrong can trigger a review. Now, I know exactly what some of you are thinking right now. John, if I claim this, is the CRA going to come knocking on my door for a full audit? Or will this somehow reduce my GIS or my OAS? Let's deal with both of those head on, because they're the two biggest fears I hear about every single CRA-related credit. First, no, claiming a legitimate deduction or credit that you're entitled to does not trigger an automatic audit. CRA runs review programs on all kinds of claims every year, home accessibility included, but that's standard process, not a punishment. As long as you have real receipts for real work that fits the eligibility rules, you have nothing to worry about. Second, this is a tax credit, not income. It does not get added to your net income on line 23600, and it will not reduce your GIS payment or trigger the OAS recovery tax, also known as the clawback. Those calculations are based on your income, not on the credits you claim to reduce your tax bill, so this credit is completely safe from a GIS or OAS perspective. Part 4. Step by step, how to actually claim it. This is the part everybody's been waiting for. Let's walk through exactly how you get this onto your tax return. Step 1. Save every receipt and invoice. Before you even think about the tax form, you need documentation. That means official invoices from your contractor, agreements, and receipts that clearly show the vendor's name, their business address, their GST or HST number if they have one, a description of the work, and the amount paid. If you're doing part of the work yourself, you can claim materials and equipment rentals, but not the value of your own labor or tools. Keep every piece of paper. CRA does not require you to send these documents in when you file, but they can absolutely ask for them later if your return gets flagged for review, and if you don't have them, you lose the credit. Step 2. Complete the federal worksheet. When tax season comes around, you'll fill out the chart for line 31285 using the federal worksheet that comes with your tax package, or that's built directly into whatever tax software you use, whether that's a paid program or the CRA's own certified free software list. This worksheet adds up all your eligible expenses for the year. Step 3, enter the amount on line 31285. Once you've totaled your eligible expenses on the worksheet, you transfer that number onto line 31285 of Schedule 1, which flows into your main T1 income tax and benefit return. If you're using tax software, and honestly at this point most seniors are because it does the math for you, the software will usually prompt you with a specific question about home accessibility renovations. Don't skip past it. Step 4, keep records for at least 6 years. C. RA generally recommends keeping your supporting documents for at least 6 years from the end of the tax year you're claiming in case of a future review. Store them somewhere safe and organized. A labeled folder or envelope works just fine. You don't need anything fancy. Here's a question I get constantly in the comments. Why didn't my accountant tell me about this? And honestly, it's not always because your accountant is careless. This credit gets buried because most tax software and most preparers are moving fast through dozens of clients during tax season, and unless you specifically bring up home renovations, it can get missed. That's exactly why I'm doing this video, because you now know to ask about it directly by name using line 31285. Part 5, the double dip trick, claiming 2 credits on 1 expense. Now here's the part I promised you at the beginning of this video, and it's honestly the biggest piece of missed money I see. What is it? Some home accessibility expenses also qualify for a completely separate credit, the medical expense tax credit found on line 33099 or line 33199 of your return. If your renovation expense fits both sets of eligibility rules, CRA allows you to claim the same expense under both the home accessibility tax credit and the medical expense tax credit. What is it worth? Let's use a real number. Say you spend $14,000 putting in a walk-in tub that was recommended for medical reasons, like a mobility issue confirmed by your doctor. Under the HATC, $14,000 times 15% gives you a credit of $2,100. If that same expense also qualifies as a medical expense, you can claim it a second time on your medical expenses total, which is calculated differently, generally as expenses above 3% of your net income or a fixed CRA threshold amount, whichever is less, at the same 15% federal rate. Combined, that single renovation could be generating value under 2 separate lines on your tax return. How do they get it? To use both, keep the same invoice and simply enter the eligible amount on both the line 31285 worksheet and your medical expenses total for the year. Your tax software will run the calculations separately. If you're working with a tax preparer, specifically ask them, does this qualify for both the home accessibility tax credit and the medical expense tax credit? Don't assume they'll catch it. Ask directly. I know some of you are sitting there thinking, this sounds like a lot of paperwork for a senior on a fixed income who just wants to feel safe getting in and out of the shower. I hear you, and that's fair. But think about it this way. The difference between doing nothing and spending 20 minutes filling out a worksheet is potentially $3,000 or more if you're stacking it with the medical credit. That's real grocery money, real heating bill money, real money that stays in your household instead of going to Ottawa. Part 6, a real scenario putting it all together. Let's run through a complete example so you can see exactly how this plays out. Picture a retired couple in British Columbia. The husband is 72, the wife is 69. The husband had a fall last winter, and after that they decided to renovate their bathroom with a walk-in shower, grab bars, and non-slip flooring. And they also installed a stair lift because the wife has arthritis that makes the stairs difficult some days. Total cost for everything, $18,000. Because both spouses are over 65, either one of them can be the qualifying individual, and since it's their principal residence, the full $18,000 falls under the $20,000 cap. $18,000 times 15% comes out to $2,700 in HATC credit alone. If part of that renovation, say the stair lift, which was medically recommended by their doctor, also qualifies under the medical expense tax credit, they could see additional savings stacked on top of that $2,700. That's not hypothetical money. That's the kind of number that can cover a winter's worth of heating or several months of groceries for a couple living on a fixed retirement income. Your action plan. Let's bring this all together into 4 clear steps you can act on this week. Step 1. Pull together every receipt and invoice from any accessibility renovation you've done this year. Grab bars, ramps, walk-in showers, stair lifts, widened doorways, non-slip flooring, or lowered countertops. Step 2. Separate any decorative or unrelated costs from the accessibility-related costs on those invoices, so your claim is clean and accurate. Step 3. Confirm who should claim it, you as the qualifying senior or an eligible family member who supports you, whichever one actually benefits more based on tax owing. Step 4. Enter the total on line 31285 through the federal worksheet when you file, and check whether any of those same expenses can also be claimed under the medical expense tax credit. This credit exists because the Canada Revenue Agency and the federal government have officially recognized that helping seniors age safely in their own homes is worth supporting through the tax system. This isn't a favor, this isn't a loophole, this is a benefit that was written into the tax code specifically for people in your situation, and it's sitting there waiting for you to claim it. If this video helped you understand line 31285, do me a favor and share it with another senior in your life, a parent, a neighbor, someone at your church or community center who might have just put in a grab bar or a ramp and has no idea this credit even exists. Drop a comment below and tell me what province you're in and whether you've claimed this credit before. I read every single one. And if you haven't already, hit that subscribe button, because next week I'm breaking down another CRA rule that could be putting real money back in your pocket. I'm John A.J. I'll see you in the next video.